Hello, welcome to the Mutual Fund Show. My name is Neeraj Shah, and in the next 20-25 minutes, we'll discuss all about mutual funds. A few key topics, a few things which are of interest over the last 2 months, and an NFO that is going to come out as well. Ajit Menon of PGIM, he's been on the show before, and he joins us right now to talk about some of the most current things. Ajit, good having you. Thanks for joining in. Hope all is safe.
Yes, Neeraj, thank you very much. Welcome to all our viewers. All is good, and I hope that everyone else is safe as well.
Yeah, thanks, Ajit. Ajit, just a brief question. Actually, it's something that I've asked almost all the guests about the kind of flows that they're seeing on the equity side. Can we just briefly start off with that before we move on to the other things? Because we've seen concurrently 3-4 months on a trot, wherein the flows have been, the outflows have been strong, and December was particularly large. How is the month of January turning out so far for the industry and for you?
Well, Neeraj, I can say for ourselves that we've had a fantastic 2020 in terms of business. We've been month-on-month net positive in terms of equity flows. And, for the year of 2020, we closed with upwards of 1,000 crores of positive equity net sales, just as the industry has seen outflows and redemption. That trend for us, at least, continues for January. I'd suspect that as far as the industry is concerned, one thing that we have seen, Neeraj, is that after a very sharp correction, which we saw in March, when markets recover back to its old levels, investors tend to redeem and then, take their next steps and their next decisions. And therefore, much of the redemptions that we have seen across the last couple of months would be related to that, as customers start keeping their capital safe and wondering what to do next, or also doing profit booking. But we've also seen strong flows coming into SIPs in December. I think January holds a little bit of the same trend. We will probably see negative net flows in January as well, but the trend has been that those numbers have been going down. November was about 14,000 crores negative. December was 10,000. I suspect that January will probably end a little lower for the industry. For us, as I mentioned, those flows have been positive, thanks to most of our funds doing extremely well on the league tables of performance. And I hope that that will continue.
Okay. Well, so coupled with that is the first topic of our day, viewers, and which is gilt funds. And they saw record outflows. Of course, the numbers are nowhere comparable because the quantum of investments into gilt funds versus whatever equity funds would be dramatically different. But Ajit, what's your sense? What should an average investor who's looked at gilt funds, who's looked at this headline, talking about how the flows were very, very high in the month of December from gilt funds, what should she or he do with a current or a prospective investment into gilt funds?
So firstly, Neeraj, we don't see too much of retail investors investing into gilt funds. Much of the fixed income allocation tends to be in the shorter end categories of, the low duration and the others. But you're right, just looking at the gilt funds, in December, I think we did see large outflows out of the gilt fund. The reason for those outflows, if I had to ascribe one to it, would probably be that the market has a sense that the rate reduction cycle is at the bottom. And what is likely to happen henceforth is probably for the rates to move up. There's time, of course, for it, but that's, I think, what the market is sensing. And therefore, we've seen people profit booking out of the gilt segment. For retail investors who'd like to allocate money to fixed income, we are obviously recommending that they stay short on the short end of the curve, which means the shorter end products, which have a maturity up to 1 year. So those are likely the ultra short-term funds or the money market funds or the low duration funds or the short maturity funds. Funds which have average maturity or duration in the 1 to 2 year bucket is what we would be recommending investors. Because going a little longer end, and typically gilt funds, for instance, would tend to have longer maturities and longer durations. With the trend that interest rates could continue to sort of move up or tick up, there is danger there for making losses. So the recommendation is that to stay with high quality funds on the short end.
Okay. The other thing which is typically a pattern in the months of December and January, for sure, if not others, is investors tend to allocate the monies for, in January in particular, for the tax saving thing. And then maybe think of fresh allocations for the year, and typically they tend to look at your rankings of the funds. So, and then they try to reshuffle their portfolios as well. If a fund's ranking has gone down or the stars have gone down, then they get worried about it, etc. I'm just thinking out loud. I mean, as somebody who's not in the ranking industry or the 5-star, 4-star, the star giving industry, put yourself in the shoes of an investor, and what would you do if, let's say, you had 5 funds, 2 of those funds came off in the ranking, and you have been advised 2, 3 funds, and you are looking to invest in them. How important would the ranking of those funds play a part in your decision?
Ranking I would say, would be a very small factor as far as the decision making for which funds to go for would be, Neeraj. What is important is that these rankings are, based on certain methodologies and would be giving certain weightage to performance of those products across time frames. Much of that could be the last 1 year's performance or the last 3 years' performance, and a bit about the last 5 years' performance. It's always better to look and compare your funds on at least a 5-year basis, a 3 to 5 year basis, to get a sense of whether you should be abandoning some of those funds or continue with it. Because in the very short term, the portfolio allocation to sectors and stocks, depending on what the fund manager believes is going to work in the near future, is what's going to decide where those funds rank. So I would say that the primary thing would be to consider what is your time frame of investment. Look at talking to your financial advisor if you have one. If you don't have one, do get one to talk about your goals and figure if the risk that these funds are taking are actually right. So rather than just the plain vanilla ranking of the products that you see going around, it is better to think about how risk adjusted are the returns that you're getting from these funds, how the downside protection portfolio characteristics of the funds that you've invested in. Understand through your advisor, of course, a bit about the process that these fund houses are following. If you're comfortable with it, I think you should just keep staying invested in those funds. To give a simple example, as you asked, Neeraj, that what would I do? My review with my advisor is always focused on what is the overlap between the different schemes that I'm invested in. What we don't realize is that we think that we've invested in 5 good schemes, but if you really look at the underlying portfolio, you're probably likely to find that the stocks and the sectors are pretty much all the same. So if we know that diversification is what is critical for good investment outcomes, it's more important to look at what is the overlap of these portfolios. And the real advice is that, look for portfolios that have lesser overlap, of course, because otherwise you're just duplicating it, even if you have 5 funds. And then look at timeframes, then look at things like rating and ranking to get a sense. Of course, your advisor can help you with all of those.
Yeah. Well, but it pays to hear out from you as well. Maybe some people might not even need an advisor if they kind of follow some simple rules that are discussed on the show like this. Actually, are there some simple ground rules that you keep in mind when you are, say, either investing your money or telling your very close, near and dear ones when they are choosing to invest in mutual funds? Ajit?
Yes, Neeraj, and thank you for asking that question. It's a very important one. The way that I follow my own investment journey is, and what I recommend to friends and family, is your number one criteria is to look at whether your protection is taken care of, your insurance, essentially your life and your medical insurance, as well as your general insurance. That is really the number one task. And especially in markets like this, a lot of people ask me, for instance, that the markets have run up. Should we book profits? What should we do? And we've been recommending that, yes, you should book some profits to make sure that your asset allocation is what it is, and use those profits to make sure, number one, that your protection requirements are adequate, and if not, fill those gaps. Number two is to have an emergency fund. So if you've had some money put aside for emergencies, if it's like 3 months worth of your expenses, our recommendation is to have an emergency fund of at least 6 months to a year of your monthly expenses. You can do that in a high quality, ultra short-term fund or, short-end products of mutual funds, or just leave it in the bank. That should also be okay. Depending on how conservative you want to be, 6 months to 1 year of your monthly expenses is your second goal. Your third goal is to look at your existing portfolio and look at what I mentioned earlier. which is, are your funds really having too much of overlap between each other? If they are, make sure that you're spread out on your asset allocation, not just within equity and fixed income, but try and include other asset classes as well. Personally, in my conversations with my advisor, what I have done in the last couple of months is to buy gold bonds. So I've increased my allocation a little bit to that asset classes as well. We're now considering putting some more money into real estate investment trusts so that we can get an exposure to the real estate investment class. I am also invested in international funds, and I'm increasing a little bit of allocation to international funds because my daughter is set to go study abroad. And it's good to have something where your rupee investments are pegged to the dollar, so it moves in tandem and you don't get some bad surprises. So having international funds give you equity exposure also gives you currency exposure. So that's what I've been doing with my advisor, and that's what I recommend to people. Make sure that you have your asset classes covered: equity, fixed income, gold and precious metals, commodities, real estate, currency. Ultra high net worth investors and high net worth investors also have a seventh option, which is called alternates, which could be things like private equity, investing in paintings and sculptures and things like that, a legitimate asset class. But for the retail investor, I think if you're spread around at least 4 or 5 asset classes, that is your objective. And in all of this, I have been very well supported by my advisor. So I would recommend that, asking the right questions to interview and to make sure that you have a good advisor is probably fundamental to getting all of this right.
Okay, Ajit, the other thing is, since we talked about ground rules for investing, I just want to talk about a few things that come into effect in 2021, right, compared to 2020. So there will be a riskometer in place, which will be for the entire duration of the year.
That's right.
Yeah, which is something new which SEBI's kind of enabled, and I thought it was a good thing. I think rules for mutual fund investing from a fund's perspective changes quite considerably.
That's right.
And I think the NAV calculation methodology also, from a annual perspective, is different compared to 2020. Which of these would have the most profound impact on an average investor's portfolio, if at all, according to you?
Of the 5, and I'll repeat the changes that have happened. As you mentioned, the riskometer coming in is one. NAV calculations being on the receipt of funds in the account is another. The change from choosing whether you want to be in the multi-cap category for equity or the flexi-cap category for equity is the third. Inter-scheme transfers have been further clarified by the regulator. And the fifth one is a small one, which is about relabeling dividend options as income distribution options. Of these 5, I think the fourth one, which I spoke about, which is inter-scheme transfers, I think will have the biggest impact as far as investors are concerned. It's a good move. It's a move to protect investors. It is a move to further clarify what fund houses and fund managers can do when they're thinking of inter-scheme transfers of a bond from one portfolio to the other. It was obviously something that was allowed. So what SEBI has done is further clarify on the do's and don'ts of those inter-scheme transfers. And they have made it very clear, for instance, how it would be in closed-ended funds and open-ended funds. The fact that if you're doing an inter-scheme transfer, you should first do the highest quality one, and you've got to have a very, very strong rationale for the buying scheme as well as the selling scheme, so that no investor gets the wrong end of the stick when something is done, and the circumstances in which these can be done. Now, why I say that this will have the most impact for investors is concerned. One is that it increases transparency. That's always a good thing. 2 is that it gives a very clear mandate in terms of what you can expect your portfolios to do. You know that it's not going to take any additional risk without very, very strong rationale for that risk to be taken. And I would say more importantly than all of that is what happens on the back end for fund houses to make sure that they follow this. And what happens on the back end is to make sure that you have a very, very strong process in place for liquidity, which means if you do face an issue of redemptions or liquidity, how are you going to deal with it? How are you going to liquidate your portfolio? Those are things where there's going to be a lot more focus. And I think that is probably, therefore, the best thing to protect investors and give a smoother experience over the long term.
Yeah, slightly patchy line, but hopefully we should be able to skim through most of the answers that Ajit gave. Ajit, one final question. You guys are coming out with an NFO as well, or maybe that NFO is already on. Tell us a bit about it.
Yes, our NFO is already on. This is one of the first full-fledged NFOs coming in from the stable of PGIM India Mutual Fund. I've always been an asset allocation champion, like most of us in the industry. And what we have launched is the Balanced Advantage Fund, the PGIM India Balanced Advantage Fund in that category. According to me, this is like an anchor in every retail customer's portfolio. This is the only category in mutual funds where you will automatically increase and decrease your allocation to equity and fixed income based on a different factors or models that each of these funds follow. It's the only category that does that. And therefore, what it does is it takes away that stress from the investor of trying to time the market. Is it expensive now? Is it cheap now? Should I get in? Should I get out? Well, all of those decisions will be taken by a model which looks at the expensiveness or the attractiveness of the market before taking those allocation decisions. For us, we are excited because it's an existing model that we had, which we are embedding into the Balanced Advantage Fund. It's very important for models to have zero discretion to fund managers, because what's the point of a model otherwise? We have zero discretion in our Balanced Advantage Fund, in terms of the allocation. And our model basically looks at a 15-year rolling PE, the long-term average PE on a 15-year basis, and then compares the absolute short-term, the last 20 days PE to that long-term average to decide whether it's expensive or cheap, and then decide on equity allocation. The single most differentiating feature is this rolling average PE, because even if I'm not in the company or 15 or 20 years from now, the model will remain absolutely relevant as Indian markets continue to mature and the PE levels keep rising. Many models in the market are static models, so we felt that a rolling average would make the biggest differentiator.
I think the question that most people tend to grapple with when it comes to investing in an NFO, that why should I invest in this NFO versus the other options that are available? Sure, every fund house has got its own investment style and the fund manager, etc. But with the presumption that other houses and other balanced advantage funds also have respectable CIOs or fund managers, let's put it that way, why should somebody come out and invest in the NFO of PGIM, this one that is coming in from your stable?
Great question, Neeraj. And I'm, like I said, a champion of asset allocation in the entire category. All of the funds in this category are great products for investors to invest into. And I wouldn't say that the PGIM India NFO is, so different from everybody else in that sense. But I would like to say that we have a model that, because we've had the advantage of hindsight of looking at these products over periods of time, of the hindsight of running an asset allocation facility for some time, we've had the good advantage of designing the solution to make it current on an ongoing basis, which is why the rolling average of the PE. And I would think that an investor only needs to ask his or her advisor the question about whether at all it makes sense to look at the kind of way that we are looking at moving into equity and fixed income, the process itself. If they feel confident, then I would say that that's the only decision to take, to also allocate to this kind of a balanced advantage fund. Otherwise, I'm a champion for the full category.
Got it. Ajit, it was a pleasure talking to you today. Thank you so much for being with us and giving us your thoughts on this week's edition of the Mutual Fund Show.
Thank you, Neeraj. And a Happy New Year once again to everyone.
Thank you so much to you as well. And of course, viewers, thanks for tuning in to this leg of the Mutual Fund Show.